All right, good evening, guys. Ken at Tortoise Capital. This is Foundation's Q&A check-in for February 15th, 2024. So, question tonight was from Jonathan, and he asked me to talk about the Bollinger Band mean 30, which is the structure we use for the river. So in our charts, the Bollinger Band mean is really the dashed red line in the middle, and then we put a plus or minus one Bollinger Band mean around that to establish the river. And then we treat that as the boundary of normal. And then outside of that, we have a Z2 plus or minus two standard deviations. And then the Z3 line we draw in red. And the idea in the color code was that, you're seeing 0.9, 99.9% of the data of that look back period is between Z3 and coming back to Z0. So we have a little Z-score ladder of Z minus 3, minus 2, minus 1, 0, plus 1 at the edge of the river, plus 2 at the floodplain, and then plus 3 at Z3. And of course, that width fluctuates as a function of price itself. So if the price bars of the last 30 are really tightly compressed, then you're going to have the Z3 lines get very tightly compressed. If there was a lot of price directional movement, you're going to have seen the Z3 lines get very wide and then start to compress. So it creates an envelope of volatility. But the magnetic pole, the center pole that pulls everything back, this giant magnet, is the Bollinger Band mean. Now, the default on Bollinger Bands is 20 and 2. And the idea behind that, and that's assuming a simple moving average, in John Bollinger's world, he felt the trade-off of going from 30 to 20 units of look back was better. Now, you need 30 data points for parametric statistics, which means that you need a large enough sample size to give you any kind of confidence that the statistical treatment that you're going to give it has any validity. If you have 30 data points, you also have to conclude or assume that that the data is randomly drawn from a larger population in order to have any confidence that when you pull a sample out of that because each one of those had a equally likely chance of being picked, that the sample is random and fair, and you have to be able to believe or assume that there is an independence between iterations of pulling data out of it. So each time I pull one out and then put it back in, that does not influence which one gets picked next. So if you have all of those assumptions together, then you're allowed to use parametric statistics, which allow you to have tighter confidence intervals and treat that data as if it really is something that is generated by a normal natural process. A natural process of some type, even if we don't know what it is, we think of that as being in a black box, and we're trying to understand what that thing is and what it could do in the future. is that if we can assume that it's random, independence, fairly drawn, and 30 data points, then we can perform some parametric tests on the sample and then draw inferences about what's going on inside that black box. If you have less than 30, you have to use non-parametric, and you have to have wider confidence intervals to account for the fact that your sample is not representative, it's not as representative of the larger population because it's too small. Well, Bollinger knows that. The reason he likes to use 20 is that he wants to, in a string of 30 data points of price, he wants to look at the closest in 20 as being more representative about what the current condition of price is. So by limiting it to 20, the more recent data has more influence on the drawing of the indicator. So if this is where price is, and I go plus or minus 2, that's normally his model is 20 plus or minus 2, then the width of that channel is driven by the last 20 bars, and so it's more representative in his mind of what's going to happen in the next few plots, and it tells you what is an abnormal move. If it goes beyond that z plus 2, he treats 2 standard deviations, which is about a 95% confidence interval. He says now we can say this is really an abnormal move, but also if it gets near that z2 and starts to reverse, it is in his belief you can have enough confidence as a trader that that's actually going to be a turning point, that you can treat that as resistance, that the next most likely thing is going to be a reversion to the mean, the average of those 20 data points. Now, I appreciate what he's saying on that, but what I prefer to do is use 30 and 1 as my definition of normal. Whereas he's not actually trying to find normal, he's trying to find an extreme that is now going to signal a turning point. Whereas my belief is that if we use 30 and 1, we know from parametric statistics and the way the standard deviation is calculated that 2/3 of the data of the last 30 fits between plus or minus 1, and only 1/6 is outside of that. So in my view, by using the longer look back period and then a tighter interval, that we can now say that the river is the normal place where traders go to get eaten alive by crocodiles. And so we don't want to trade inside there. But what we want to do is we want to find breakouts from the normal condition as the start of the next trend up or the next trend down. So we're looking for this violation to be the beginning of the trending behavior in that direction. Whereas Bollinger, with his his 20 period look back and then plus or minus 2, is trying to anticipate the edge of the channel as the likely turnaround point. So he's not interested, if I were to draw the plus or minus 1, he's not interested in this trade that departs what we call the river to see how far it's going to go, because he knows that it's only one more standard deviation to here, and if it's likely going to turn around there, then that's not enough room to really generate a trade. So he's not trying to play the breakout from normal. He's trying to treat the plus or minus 2 as normal, and that the reversion to the main trade is the one that he wants. He's looking for the move from plus 2 back to 0, and then possibly all the way down to minus 2. Whereas in our view, if you have 30 data points and you have the averages here, and then you have Z1, Z2, and Z3, it turns out that the breakout from the river gives you a tradable opportunity up to Z3. And then if it goes beyond there, you have exaggerated breakouts, and now you can get a second leg up. So in our view, it makes sense to look at the start of that new trending behavior as a departure from normal. Whereas what Bollinger is he's just treating the Z2 to minus Z2 as the giant normal. And what he's really looking for is just the reversion to the mean trade. And the reason he likes that is because in his view, it's too hard to it's too hard to predict when this normal price action inside the plus or minus uh, 1 or 2 around the average, it's too hard to predict when it's going to break out. And he thinks it's better to see it actually move to an extreme distance, in his case, plus or minus 2, and then see it actually start to revert and then just play that trade because you know how big the move back to the mean is. Like on the breakout from normal, you don't know how far this thing is going to go before it reverses. So rather than play on the uncertainty and the potential, he likes to see the actual move reverse and then play reversion to the mean. So that's what I want to say about the difference between 30 and 1 as we use it and his 20 and 2. My bottom line, want the validity of a larger sample size and a slower moving average. And I want a tighter envelope for the river. And I'm actually going to use 3 layers going from 0 to +1, +2, +3. I'm going to have more rungs on the ladder going up than he typically uses in his default structure uh, of the width of the Bollinger Band. All right, so let me check in with you right there and see if we're so far so good.
Good.
Yeah. All right, now the next one that we're going to do now, this is something that he doesn't do in his default, which we do, is that we're actually going to use a pair of Bollinger Bands. The first one we're going to use is the slow, which we're just going to treat. I'm just going to treat the river and the center of it as the slow moving. So if that's the river, this is in SMA 30, and then this is the plus or minus 1 Bollinger Band on the look back period, and we're going to call that the river. Now, the second thing that we're going to do is we're going to take a 10 period simple moving average, and we're going to look at that as the fast moving average. And what we're interested in is how far and wide can this 10 period moving, and I'm going to make that thick because we're going to use a half a standard deviation plus or minus. So we have the thicker dragon. Now the dragon is a 10 and plus or minus 0.5. And the river is going to be 30 and 1. And we're going to treat that as the normal behavior of the herd. And then what we care about are the excursions of the dragon and to the peak excursion, and then the reentry, the crossing. So we're going to always be interested in these checkpoints in the dragon. Now, one of the ways to look at the relationship between the dragon and the river is that the dragon is fast and adaptive, much more adaptive, and the river is slow and lethargic. Now, the dragon is 6 times more adaptive. And the reason I say that is because it's only 1/3, or it's 3 times faster than the river, and it's half the size in the noise channel. So the width of the dragon actually establishes an envelope of normality, but it's half the size of the river's width because it's only 0.5 of a standard deviation. So when you take those two together, it gives you the dragon is 6 times more adaptive to changes in price. So each one of these is taking a look at price bars in a certain way. But whereas the river is considering 10, 10, and 10, it's considering 30 periods of look back. The dragon is 3 times more adaptive because it's only looking at 10 instead of 30. And the width is half a standard deviation instead of a full. So in their own way, each one is describing a boundary of normal price behavior. And so if price is inside the dragon, that's truly genuinely normal. But because the dragon is only plus or minus half, that boundary of normal is half the size of the river. So that's why I would say it's 6 times faster to adapt price action as compared to the river. Now, that's one of the ways that we get around the Bollinger. Hey, isn't the Bollinger Band default with 20 and 2? Isn't that faster than your 30 period? Yeah, but because we're also using a 10 period, the combination of a slow and a fast gives us two different ways to triangulate insights about price that gives us more actionable information. Whereas a single Bollinger Band only lets you turn around when it hits the 2 standard deviations and then rolls over. Now, one of the things that we can now do is we can say each of these conditions here is actually a price. The dragon leaving the river is key, and the maximum distance from the Bollinger Band mean to the very peak of the dragon, if we draw that tangent line, this peak of the dragon is actually a statistically significant maximum excursion from the mean of the river. So if we were to measure this line from here to exactly there, that gives us a way to have a calibrated size and strength of that move. That's how far they were able to move it away from the absolute center of normal. So how strong are the traders? How strong are the fast, aggressive young traders? Well, that's how far they could move it. They could move it all the way up to the peak of the dragon. And then one of the things that we notice is that it's not unusual to see symmetry around that center line of the middle of the river. That as far as the traders can take it south is how far they can take it going north. And then if it crosses again, how far south can we predict that it goes, but we're not allowed to be surprised if it moves as exactly as far as it did in the other direction on the reversal. So now if we are looking for turning points, price went down, then starts to turn. One of the things that we can do is take a look at the turning point of the dragon, which is also going to be close to where the turning point of the RL10 turns. Now we can add the 10-period regression line in as our price. And then one of the things that we know is that the 10-period regression line is faster than the 10-period simple moving average of the dragon. So this is also a way of looking at fast and slow in a more refined way. And one of the things that we know is that the regression line is more adaptive than the dragon. So it will reach its downward point and then start to revert 2 or 3 bars sooner than the dragon rolls over. So the turning point of the RL10 is followed by the turning point of the dragon. And then if we were to look at subtle changes in the direction and slope of the river, we'd see that that thing is even slower to turn than the dragon and the RL10. And in the same way, the RL30 can be compared, as we talked about last week, the RL30 and the SMA 30 is a way to look at fast and slow with respect to a 30-period look back. So there are multiple ways that we can look at this idea of fast and slow and how quickly do we want to be taking signals. We'd like to get some warning and early alerts and so forth. Okay. So one of the ways that we look at the actual turning points of the dragon is that we would like that the width is wide enough that we could make a living trading from the turning point in the dragon to the turning point in the dragon. And in fact, that's what we actually do with the sniper trading, is that when price goes through the dragon, very shortly thereafter, it's going to hit a PSAR. And so when I see the RL10 is going down and in the harsh winter, when it crosses the dragon, in other words, here's where it turns, it reverses up, and here's where it crosses, it enters, and then where it leaves the dragon. That little moment is not a bad place to enter. Usually the PSAR is very close to that skin of the dragon on the way down. And so you end up getting entries in the sniper right in that region. So that's essentially what we're doing, is we're entering as close to the upper skin of that turning dragon as we can. And then, as you know, from the way that I manage exits, when this price has moved as far as it can and starts to roll over, one of the things that I'm stalking is the RL10 as it gets to a peak and then starts to reverse. And when the RL10 reverses, you've seen me 1,000 times take the skin of the dragon as the amount of price that I'm willing to give back. So you're actually seeing me trade from skin of the dragon to the skin of the dragon. As long as price is on the north side of the dragon when it's going up, that is the region of excessive gains. That's where price is moving faster than those normal moving adaptable curves. So that's a really important concept that I want to bring back now and take a look at this idea here, that the Bollinger Band mean is the last and final tripwire to define the end of the current trend. Here's what I mean by that. Let's suppose that the middle of the river was here, and then you had something like a tightly compressed river right here. And now all of a sudden you get price action that leaves the river. Now it's going to go up as far as it goes, and then it maybe hits a perfect doji. And now all of the guys who were in the buyer's club with all their money, it's done. There's nobody left. And now all of a sudden, the sellers are in charge. And it's not unusual to see things climb the wall of worry going up the stairs and then fall out the window and get a rapid reversion to the mean. So you get something like climb up the stairs, fall out the window. The failure, the collapse of buying pressure creates a fearful move to the downside. So you get sharp reversals. So how long should we stay into that trade? We can have some estimate about how far this thing could likely go based on previous statistics. Can it go that far? But another part of me wants to say is, I don't really know how far this thing can go because I don't know how many buyers there are and how much money they have and how they're going to be influenced by the momentum on the way up. I have to wait and see. So my preference is to let me see the far side of the hill. So if I think of that mountain that we're climbing, and somewhere in here we buy a breakup, I like to see the far side of the hill and get some exit. Well, one of the ways that I can think about that is I could do a trailing stop of some size. If this was my wrist box, some carefully calibrated wrist box, I could just use a trailing stop of that one, and then when it moves one wrist box off the top, I'm willing to give back as much as I was willing to risk. And then what I'm trying to get is that move in the middle. Another way that I can do that is simply to say, um, let me take some of these measures of normal behavior where price is moving along and improving, and let me take a violation of that to be um, the signal that the trend is over, rather than just an absolute value of some retracement of dollars. And so we have a number of indicators that we can use to do that. One of them is the RL10. Now, the RL10 is not a good trailing stop as a boundary of price because it is actually the price. We're using that as the definition of price. So you can't have when price crosses the RL10 to get out because it's designed to be right in the middle of price. And so on a perfectly normal day, you're going to see price on either side of that routinely. So the RL10 cannot be used as a measure of normality to trigger an exit. So the RL10 goes up and the RL10 goes down. That's the steepest. Now, the next thing that I might consider using, and my brother uses this a lot with tight stops, is that the baby dragon is a 3-period simple moving average of the RL10. And so that thing is tracking the last 3 data points of the RL10 and then computes that average. And one of the things that we notice is that when it crosses its own 3-period moving average, that really captures most of that previous move. That what that does is when this is an orderly buying pressure and it goes up and it's always making higher lows, it never threatens the simple moving average 3. But then when the RL30 rolls over, the aggressive exit is that when the RL10 rolls over its own 3-period moving average, that we can take that as an exit. So that's very close. The next one that's close, the next closer one is usually the dragon. So this is a 10 period simple moving average. And that's going to look like this. I have to draw it a little bit wider because it's a Bollinger Band, right? And in our discussions in the course of, different possible exits, I've actually considered at various times like the upper skin of the dragon, the spine of the dragon, and then the lower skin of the dragon are three different computable levels at which you could have exits. And then the PSAR is because of math, the PSAR usually lags the dragon. And then the upper skin of the river, which is a 30 period Bollinger Band plus one, that's the boundary, is usually up in here. And then way back here, the slowest one is the Bollinger Band mean itself. And so I'd like you to think of all of these little price levels as places where you could put your trailing stop as computed by mathematics, describing the price action so far. So the two ways of really measured, to me, one of them is sort of the maximum excursion away from the peak of price, where you just say whatever the maximum peak was, and I just hang some kind of risk box off it. Or I could pick one of these continuous lines as my trigger to get out. Now, the reason I say that the Bollinger Band mean is that is the last and final tripwire to define the end of the current trend. So once this thing broke out, we had some kind of trending behavior going up. The very last measure, the most conservative definition of that trend, is the Bollinger Band mean. So whatever trend there was that made price go up this high, the actual impact on the Bollinger Band mean, the center of the river, was here. So in this theory, in this belief, what you have is that the new price level is here. That's the new fair normal price. It used to be down here, and now apparently buying pressure was enough to push it up to a new fair value. And so all of this price action that was north of the Bollinger Band mean was just psychotic, irrational, optimistic gains that guys were trying to anticipate even bigger moves. But really, the trend of that upward move is over if it can't even stay above the middle of the river, the Bollinger Band mean. So in that logic, the last place that you can have a trailing stop that gives the trending behavior the most flexibility and room keep going is the Bollinger Band mean itself. What that means is that when you're thinking about where does the price revert and start going the other way, a crossing of the Bollinger Band mean is now an important moment because all of the favorable optimism has left the building, and now you're entitled to have a negative bias. So, in other words, the last door that closes on that trend is the Bollinger Band mean, and that's what I mean. It's the end of the current trend, which was up, is now over when price has reverted all the way back to the mean and then starts going lower. Check or hold.
Okay.
Now, the next idea is that the Bollinger Band is also the target that is the least surprising move. So if we had price moving along here in the middle of the river, and then there was some kind of trending behavior, and it went up as far as it could go, and now it starts to revert, we're going to use some kind of definition to say how much does it have to revert before we think that what we have now is not a breakout, but now we have reversion to the mean. And so the mean that it is going to revert to, we're going to define as the Bollinger Band mean, the simple moving average 30 in our construction. Now, I want you to notice that when we're talking about the regression line fractal framework, the same idea occurs when you have the RL270 and the 90 and the 30 and the 10 all very tightly clustered within a frog box on the intraday or an ATR on a swing trade. If those things are all tightly clustered, then we can say that all four demographics, from the active traders all the way out to the long-term buy and holders, they all agree that this is the fair value. And it'll stay that way until the traders decide, for example, to move price down in this direction. And how far can they take it? I don't know. But when it reverses from a sharp point. And then because of math, the RL270 has hardly moved at all. We can now use this same logic to say that the strength of the traders was measured in a distance that they were able to move it away from the RL270. In this case, the quote unquote mean that this trade is reverting to is going to be, that role is going to be played by the RL270. And the idea there is that we've given it some amount of retracement back towards that price level, which we put a risk box on. And as long as we can see 2 or 3, then we have a tradable move, that the size of the move down and it started to revert is tradable. Well, in the same way, we can take a look at where the RL10 turned and go from the RL10 and then pick the simple moving average 30 as the distance for the reversion to the mean. And then if we have a measure of, say, an R10 or an R5 or whatever we're using for the MMRB on whatever price time frame we're looking at, whatever that risk box that is manageable is, and that box has to be big enough to suggest that a reversion to the mean is happening, is we can now measure that distance back to the Bollinger Band mean as leg 1. And then if it gets to leg 1, it completes leg 1 all the way down to the Bollinger Band mean, then we're not allowed to be surprised that it goes that same distance beyond the Bollinger Band mean. The RL2 in the regression line fractal framework always is fair value for the long-term buy and holders. And that's a relative term. Long-term buy and holders, we define that as the, wherever the RL270 is on that time frame. So if I'm looking at a 3-minute chart, the category of guys that are long-term buy and holders are guys that are holding 270 bars times 3 minutes, which is 810 minutes, which is about 15 hours, which is 2 days. So the RL270 on a 3-minute bar is basically taking 2 full days of data, because there's about 270 3-minute bars in 2 days, and wherever that regression line is, as drawn by those 2 days of 3-minute bars, that last dot in the RL270 is where the RL270 is printed at. And we're going to take that as the fair value going forward. So now if these were the 2 days, 1 and 2, and the RL270 had printed up in here near the high, just like this one, and now all of a sudden on day 3, price action, and we're going to say, for purposes of the RLFF, the RL10 is up in here. Now, in that moment, both the RL270 and the RL10 both agree that that's the fair price. The traders think that's the fair price because they moved it from here to there. And the RL270 thinks that's the fair price. Well, what if the next day traders are able to move the price all the way down here and it starts to reverse? In about 4 hours, the RL270 is only going to move about that far. Instead of going up, it's going to flatten out and go right about there. And so what that means is on the 3-minute bars, these guys represent long-term buy and hold. If this is a daily chart, then it needs 270 days, which is about 14 months. What's important in the regression line fractal framework is that the relationship between the 270 and the 10 means the same thing on that time frame. And in the RLFF strategy, you have 4 regression lines. The 10 period is the trader's price, always, is what that means on any time frame. That's where the traders think the fair value is for price. And the 270 is the long-term, relatively speaking, the long-term buy-in holders, the conservative guys that are slow to change their opinion. The 30 represents the health of the current trend, and the 90 represents the health of the trend at the next higher time frame. So what we really have is 4 categories of traders who are more or less aggressive. These guys are very aggressive. These guys are least aggressive. And then we look for the difference of opinion between the 10 and the 270 to frame that trade, from the fast movers to the slow rollers. That's the right way to think about it. It is fractal and relative. Okay. Now, that idea of the reversion to the mean on the regression lines is the move when the 10 reverses and it's going to go back to meet the 270. That is technically a reversion to the mean trade. On the example I just gave you on the intraday, the move of when there's a sharp breakout and the RL10 moves up to a peak and starts to reverse, from the peak of the RL10 down to the middle of the river is also a reversion to the mean trade. In this case, it is actually and technically the Bollinger Band mean. I want you to see that these are very strongly related ideas. They're like brothers. That's how close these things are in relationship to each other. Now, so what I want to say then is that it is the target that is the least surprising move. After I get an abnormal move, maybe that thing went beyond what used to be Z3. And this is what I mean by normal and abnormal moves. So let's say I had the river, and then I had a Z plus 2 and a Z plus 3 way up in here. And those are drawn by how sideways or volatile the price action has been. And now, so if this was the normal, and then this is the boundary of the river, plus or minus 1 And then the floodplain is plus or minus 2, and this is the z-score plus or minus 3. That is the boundary of rational exuberance, if you will, based on the last 30 bars. So now if something all of a sudden happens and I get a breakout, this sharp move could go beyond Z3. As soon as it starts breaking out of the normal, that Z3 line is going to start expanding to accommodate all of the volatility moving up. But the price action could be so violent that it goes beyond Z3. It's hard to stay beyond Z3. And in fact, when we see two bars that look like this, and then price stops going up because the buyers disappear, and then we see price move back inside the Z3, we call that the dragon horns, because it looks like the head of a dragon. And here's price moving down with his little fangs, and those two things look like his ears or his horns. When you see two bars north of the RL of the Z3, and then it starts reversing back in, you better be ready to capture the big move that you just saw, because it's probably over. And you'll have the Z2 line will be here, the Z1 line will be here, the Z0, which is the reversion to the mean, will be here. And so when you see that happen, you want to be taking your exits in here or at 2-bar low or at Z2 or from the peak of the price, some price box to the downside, something. Or the skin of the skin of the dragon will be up in here somewhere. But one of the reasons we get out even sooner than the skin of the dragon is if we saw the dragon horns. So that's just a piece of folklore for you. Anyway, once you have this abnormal move that blew out beyond the limits of normal, this is an abnormal move. The least surprising move is a reversion to the mean. That is the most unsurprising move of all. And then if it actually does that fast, we're not surprised if it goes another distance beyond. How far could it go? It could go to Z minus 1, Z minus 2, and so on. Or however far up it went, it could go that far down. However far it went above the Bollinger Band mean to the maximum excursion, it could go from the Bollinger Band mean down, and we measure it from the place where it crosses. So if we were to use the Bollinger Band mean as our conservative trailing stop, we've given it the widest amount of room to continue to find its way north, a pullback and then buy on dips. So if we're using this conservative 30-period simple moving average, we've given it the widest amount of room in order to recover and go on to the next leg, but it also gives back the most of our abnormal gains. We entered that trend early on the potential that was indicated by the breakout. So that's aggressive. And conversely, using the Bollinger Band mean is the most conservative of the trailing stops. So I also want to say this, measuring the distance away from the Bollinger Band mean, so I can now measure from how far it moved from the breakout to the maximum excursion. I can use that as a measure of strength. Say, how far up were they able to take it to the maximum favorable, and then take a look at the time it took to do that. And the shorter the time, the more volatile. So that tells me the distance up tells me the strength of the move. The short amount of time that it takes to do that tells me about the volatility on departures from the mean. And that allows us to measure how aggressive the trader's psychology is in making that bold move. And the logic is that this move will only stop when all of the traders who were buyers, when they run out of money, the buying pressure disappears and that puts a lid on it. And now everybody who was on the sell side of this are interested in bringing it back down. I want you to think of the Bollinger Band mean as the zero line on the metronome in partnership with the RL30. So this is looking at the fast RL30 and the slow SMA 30. So you can actually track in the same way. The SMA 30 is the middle of the river, and then you can track and see how far did the RL30 once it crossed, how far did it go before it rolled over and came back? And you'll see that thing tacking back and forth like a metronome. And one of the things that we use the RL30 for is when it rolls over, that's the fifth criteria of the owl. So this is the most conservative way to mark off a reversion to the mean trade. And where's the mean going to? It's going here. And when the RL30 crosses the SMA 30, that entire run has gone up and has now come back. So that run is done. And now you're thinking about this move. So now how far below can it go from here to here? And that's one of the reasons we like to measure this distance from the SMA 30 up to the peak. We think that once this thing crosses the SMA 30, we're not allowed to be surprised if it goes all the way that far before it starts to reverse, because you will see asymmetry. Now, what I've drawn that as is as a pure sideways SMA 30. So if this was in a pure sideways channel, that should be red, sorry. Yep. If that's the SMA 30 and it was a pure sideways market, you would see it trending exactly like this. It's symmetrical about the, but sometimes the bears will be in charge and the river is sloping downward. And when that happens, what you'll see is that the SMA 30 is still going to be symmetrical with respect to that axis. And now you're seeing that downward sloping of lower lows, lower highs, and now you have a channel that can be defined by the peaks and valleys of the RL30. And it's going to continue in that way until price improves, and then slowly the SMA 30 will round off. That will be a slower turn because it's slow than compared to the RL30, which would then go like this and start leading it. The RL30 turns faster and is more volatile. So you can watch what's going on in the market for turning points based on the relationship between the Bollinger Band mean and the turning points in the RL30. Now, the other thing that we can measure is that we can say is the degree that the slope changes. So if I have, and I'm going to use the RL30, but the mean could also be the slope of the river. So if the river is exactly sideways, you could then say at the worst movement downward, and this thing turned south and went this far, and then it rolled over. At this point here, what was the downward slope? I could measure that angle alpha and say what was the degree of downward slope. And then when it started to turn, I said, I mean, that's the maximum adverse slope, and maybe it could go that far up. That's the same logic that we use when we're measuring the z-scores of the RLs, the 10, the 30, the 90, and the 270. For our purposes, it's better to measure the slopes of these lines than the simple moving average 30, only because these are more dynamic. They change faster, and it allows us to get into trades sooner. But conceptually, you can do the same thing at a distance by looking simply at the uh, uh, looking at the simple moving average 30, the middle of the river, as the no kidding strength of that trend, and you can start seeing the behavior of large indexes, especially by just looking at the slope. And the steeper the slope, the more exaggerated the move and all that jazz. So the slope can tell us something about the duration and the size of the move. How fast did it move from flat to downward, and so forth. The text of this, this is what if when we go into Chat GPT 4 Turbo and a couple other AI robots, and we say, all the what are all the different ways that guys have written about using reversion to the mean in their trading, and have it scan and synthesize from the writings of 100 trading authors. These turn out to be the ways in which it has been used. And I've talked about identifying price levels of value, managing risk. You could use it for portfolio diversification by having some trades that are playing the breakout away from the mean and some that are playing reversion to the mean, so you get something like an aggregate diversified return. You could use reversion to the mean or breakouts from the mean in terms of developing systems and strategies. You can use it as a market classification system, the slope of that of the mean as a measure of market sentiment. That's what we use the slope statistic for. Cyclic adjustments, you could say, by measuring what the average departure from the mean is, you could start using that as the time to start rebalancing, that you stick around as long as it is gaining up to some limit of normal gains, and then start trimming that position to take advantage of the abnormal gains. And then you could use that as a timing indicator and performance indicator to start rebalancing portfolios. You can use it for long-term planning by taking a look at longer time frames to look at what the long-term channels and the absolute gains and losses are over long periods of time, 3 and 5 year look backs and so forth. You can use reversion to the mean to help you reduce the volatility of your equity curve by using a system of systems that uses a blend of strategies. It's a way to start measuring and increasing your profitability in range bound markets. And that's where where you don't have breakouts from the Z2 or Z3 lines, you can actually anticipate those to be probable turning points. But what do I mean by that? That if I thought it was a range bound market, and so I had something like this, and then this was my Z3 lines. I could take that and estimate that the forward moves were going to be like this, and that price might continue to go up until it got this far, and then it would roll over. So now I could start talking that in terms of time and say, hey, as it gets close to this area, I could start my selling process. And now apparently a lot of people are going to do that, because that selling is what starts this strong trend to start weakening, as people are taking this as a profit taking opportunity, capital preservation, as opposed to a buy on dip. In fact, they're just selling their position instead of coming in and buying every new dip. They're actually selling in order to preserve their gains. So now instead of recovering, it accelerates the failure. So you can use the shape and the cycle time of those channels. as ways to trade inside the channel when it has an upward or downward slope. So channel trading doesn't mean that it's only going sideways and that you're trading price like this. This thing could also be tilted up, and now you're anticipating where that next turning point is going to be. So now you're getting caught at two entries in here when that market turns with higher lows. But then when it gets near that anticipated turning point, you're looking to capitalize by cashing in that way. Instead of letting it just run, you're looking to start selling it here, which actually causes price to start to roll over. Right. So those are the things that I wanted to say about the Bollinger Band Main 30, the way we use the 30 and 1 um, Bollinger Band instead of the traditional 20 and 2. Jonathan, go ahead. You have a question?
Hey, there's one more question. You've got
Sure.
both VWAP and the Bollinger Band mean on
Yeah.
your 30-minute and your 3-minute
Yeah.
charts. So how are you?
I'm
How
using
are you
them.
prioritizing?
I'm really using them in the same way. They both
Okay.
act like a giant magnet, but they're created with a different formula. They both are giving you something like the center point of true value, but the VWAP is a special case because the VWAP is constructed by the number of shares times the price, and it gives you a weighted average, a mathematically weighted average that's adjusted by volume. Whereas Bollinger Band mean, it's simply the last 30 bars creates the Bollinger Band mean. So it's only looking back 30. But the VWAP is constructed right from the open and takes into account all of the shares at all the prices they were traded at. So the VWAP is what is used by institutional traders in their mark to market when they're looking to see if I gave you price improvement or not. So the VWAP acts like a very specific magnet that is geared directly to volume and price all day. Whereas the Bollinger Band mean is an approximation of fair value, but only based on the last 30 bars. It's not unusual to see them very close to each other.
Okay.
But you can, and the Bollinger Band mean is more adaptive than the VWAP because the longer it goes during the day, the more previous baggage the VWAP has to carry. Because all the previous pricing action and all the volume is still being carried forward to compute the next VWAP. Whereas the Bollinger Band mean is only going back 30 bars. And so it's much more adaptive. What you'll see is something like this, where the VWAP, maybe this is where it closed. So let me draw that a little better. Give us a little more room here. So from the start of the day, um, there might have been a gap. So the VWAP could have closed here, and then there was a big gap up, and that's the open. And because all of the new price action is being bought right here, the VWAP immediately jumps up to where the open was. And then you'll get a flurry of large volume, and you might have the VWAP look like this on an up day. And then the longer it goes during the day, it just kind of stabilizes. And price will do something like here, and maybe it goes up to here, and then it keeps breaking out, but on lower and lower volume. And then later in the day, if I go look at if that was 30 bars, the Bollinger Band mean, the simple moving average 30, could have been something like this. So there was a time early in the day when they were both here. But now when price starts rolling over, here's the RL10. That could have been enough to start triggering a move back to the Bollinger Band mean, or when price gets through the Bollinger Band mean, now that move is over. That was all the excess gains. And now you say, how far could they now move it now that we've seen the peak? And what if that's moved to R10s from the peak? By the time of the close, it's not unusual to see price come all the way back to the VWAP. So in one sense, there is a reversion to the mean trade from the peak of the RL10, all the way back to the Bollinger Band mean. But in another sense, the volume weighted average price is a form of moving average. There's also a reversion to the mean back to the VWAP. So the short answer is both of these act as a reasonable price target intraday that once you get a peak move, in a perfect world, it opened here and it moved a range stat. Wouldn't that be perfect? And then you say it already moved the maximum reasonable distance, and now it's starting to reverse. The first target might be to the Bollinger Band mean, and the second target might be to the VWAP. Check or hold.
So the Bollinger Band mean is more responsive, and
Yes.
it's giving you an average and a more recent price average, whereas the VWAP is, maybe you could say it's
Yeah.
more really value. So
because look at it this way. If this was my open, and now let's say that I'm 4 hours into the day and I'm on the 3-minute bars, I have 20 3-minute bars per hour. I have 80 bars of price action on 3 minutes, right? To get to the 4-hour mark. But the Bollinger Band 30 is only taking a look at 30 of those. The SMA 30 is being geared off of those prices. And let's say price looked like it was going straight up. Maybe it went straight up for 4 hours. So if that's where the last 30 bars are, and if it was perfect going up, if that was the high and that was a low, the mathematical average of those prices is high minus low over 2. So this might have been just one bar. So that's where the SMA 30 is going to show. The VWAP was taking into account if there was a lot of volume transacted at this price level and only smaller amounts of volume here. So I'm doing volume at price instead of volume through time. But if I'm showing with volume at price, how much volume is transacted at this price level? There was a lot of volume. The VWAP is going to be influenced by the fact that there was a lot of volume down here. So the VWAP, which takes into account all 80 bars all day, might be all the way down here, whereas the SMA 30 is way up there. And the SMA 30 was very adaptive, but the VWAP has to carry all of the early price action as well. So it is the longer it gets in the day, the slower it is to react. Because if in the first hour there was 1 million shares traded, and then in hour 2 there was 100,000, and then in hour 3 there was 10,000, and in hour 4 there was 1,000 shares being traded, because now it's only the traders, whereas this was institutions. If these guys were all buying it and selling it down here, the volume weighted price is going to have a lot of influence about where the VWAP is. Whereas if price was kept going up like this, there was only 1,000 shares traded up at this level, but there was 1 million shares traded at that level. The VWAP is going to be much closer to this because of math. Check or hold.
I got it. So thank you.
So this little diagram here, uh, these are all the points that I was making. And again, here's our Park River, the RL10, the turning point where the winter turned to spring in the MACD. The R10 turns to spring. It entered the dragon. It left the dragon. Here's where the dragon went from down to up. Here's where the RL30 goes from down to up. That's usually the time frame where things happen. This turns first. This turns second. That turns third. And this is where you get the owl entry when the RL, but price could have moved all the way up to here. Whereas we want to get the earlier entries when price crosses the dragon. Now, if I was able to get short here, then when the R10 reverses, this is where I actually like to take my exit at the skin of the dragon. Because for me, the excess gains were really south of the dragon. That's where the advantageous price action is for me on the short side. And then when it crosses the dragon, that to me is kind of like the zero line. And now I'm thinking about how to get the RLXD entry or the PSAR -1 entry. One of those is going to get me in. So I get in a little bit earlier here instead of waiting for the owl here. But the owl is legitimate. It's just a conservative entry. But after the RLXD occurs, then the next indicators are the dragon turns and then the RL30 turns. And that's what gives you the owl entry. But this is the SSC. And then all of them are looking at, now I've shown the Bollinger Band mean declining a little bit because all of this price action is causing the RL30 to decay. So it's always going to have a declining value. And what you're looking for is how fast can I get from the crossing of the dragon up to the, the reversion to the mean. And I think of that as leg one. And then however far that is, I think, well, that's leg two. If I'm lucky and this thing keeps going beyond, and this is where we're talking about oscillating on either side of the Bollinger Band mean. The other thing that I look at is also in a downward move, you typically see the Bollinger Band mean closer than the VWAP. And the crossing of the Bollinger Band mean gives me an upside bias, and crossing the VWAP absolutely gives me an upside bias. But there's something really powerful as you get later in the day about where the VWAP is. I am not surprised when price gets to the VWAP. I don't really expect it to get beyond the VWAP, but I do expect it on a strong move to get beyond the Bollinger Band mean. It goes this far, and then it reverses and goes that far. So that's how I distinguish between the SMA 30 and the VWAP. They both act as the mean and price targets, but they behave a little bit differently, and they're computed a little differently. Check or hold. Sounds think like we got it. Okay. Let's see. Greg says time targets. I don't know. I just duplicate the previous prices and I just clone them and put them in there. And then I watch the actual price against that and say, is it going faster or slower than the previous move? The one thing you can say is, reasonably, is that before the end of the day, price is going to get back to the VWAP. Change my mind.
And Ken, on the chart itself, are you
And
actually
yeah, go ahead.
on the chart itself, I'm starting to draw on the chart all these plots and of these
straw
different legs. Is there a best practice as far as labeling it? Because it's for me, it's gotten crazy.
I just use colors just like that. I mean, I typically use a blue color to show planned moves. So if I saw this and I saw it went down that fast and came back this fast, I'd say, hey, what's a 45-degree angle? And then project the Bollinger Band mean forward. And I just say, from this point here, instead of the Bollinger Band being flat, I think it'll decay that much. So I just extend that in a straight line. And then this is the objective or the rational line. And then I watch and see, where is price moving? Did price move up on this side of the objective? Well, then that's a really aggressive move. And now there's a better than normal chance that this thing goes beyond, because they're really hitting it hard. They're hitting it faster than I thought. But if price was grinding this way, that's not one that I think it might not even get there, because it's below the objective line. I just draw that as a 45-degree angle and just say, there you are. Now, if you're using the regression line fractal framework, you actually have 270. You have the RL10 came down this far, and then you'll see the RL30 came this far, and that marks the P1. That's potentially an entry. And then typically the RL90 will be something like this, and then that acts as a checkpoint. I just draw that line like that, and I estimate in time, where could that thing get to? If it took 1 unit at a time, it probably takes 3 times as long to climb the wall of work. But if this was an exaggerated fear-based move, then this should be a greed-based move, and they're both, that's why I draw it as symmetrical. And then that becomes the objective line. And then is price moving up in here, or is it moving up on that side of the line? If it moving faster or slower than the expected. And that's just a rule of thumb. You don't overthink that. Okay? All right, that's everything we got for today. We'll get this posted shortly.